To me, like a curator is someone who sits on top of the code and acts like a portfolio manager by picking pre-approved strategies, setting allocation rules, and adjusting various risk caps without touching user funds. That's like the ideal scenario. And unfortunately, I believe the rise of permissionless lending markets has led to an explosion of the number of curators, and not all of them are as experienced, or they might have different motivations, might run a more loose risk ship than others. So that's where it can get tricky for the end user.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. Today's show features a conversation around the role of risk curators in DeFi. So we invited our friends from KPK because they have been working as risk curators before the term was coined. They've been working with some of the largest DAOs in the space like Gnosis to manage their treasury going back 5 years ago. So they are well placed to speak on all that's happened here in the past week.
Yeah, we get into the role of a risk curator. We talk about the misalignment of incentives maybe between curators and users, and we talk all about how to better assess risk amongst all of these vaults.
We do break down what happened with Stream and Elixir. We try to simplify a number of the blowups that happened and some of the contagion that ensued. But I think the real focus of the conversation is understanding why permissionless lending markets can and should work, and why there is so much interest in these tokenized yield vaults. I don't want to throw the baby out with the bathwater on all of this. We are hopeful that these are primitives here to stay. It's just that the shortcomings have clearly been revealed this week.
So not only do we get the opportunity to hear the expertise from KPK with a lot of the stuff that went down this week, we also talked to them about what they're doing to kind of move this curator space forward, and some of their automations and practices that they're going to be bringing to market.
So before we get started, just a quick reminder, you can subscribe at the-edge.xyz. That's the best place to subscribe to the Edge newsletter and to get real-time notifications for the Edge podcast anytime we release a new episode. You can also check out our link tree at edge_pod. That's the best place to subscribe to the Edge podcast on Spotify, Apple Podcasts, or YouTube. And then one last shout out to all of our sponsors that make the Edge podcast and the Edge newsletter possible. Sponsors like TOROS Finance and REDSTONE. Otherwise, we hope you enjoy the episode. Grow wealth exponentially. With TOROS leveraged tokens, when the market moves in your favor, your gains become parabolic. They're built to ride trends, auto-compounding profits. With TOROS, it's simple. Pick a vault, deposit, and your exposure is multiplied, maintained, and protected automatically against liquidations. TOROS reduces risk and keeps you in the market ready for the rebound. When markets dip, the vaults auto-adjust, softening losses and preserving your position. Just pick a token to multiply your returns. TOROS Finance, exponential gains with leveraged tokens. To learn more, go to toros.finance. REDSTONE is building the Oracle backbone to unlock real-world finance on-chain and next-gen DeFi. With modular gas-efficient feeds across over 110 chains, trusted by 170 clients, supporting over 1,300 assets, from value-accruing stablecoins, liquid staking and restaking tokens, to treasuries, private credit, and commodity tokens, REDSTONE delivers accurate real-time data where it matters most. The biggest platforms and protocols in DeFi today choose REDSTONE oracles, such as Athena, Securitize, BlackRock Biddle, Pendle, Spark, and Maple Finance. If you're building the future of finance on-chain, you need REDSTONE's leading modular blockchain oracle layer. To learn more, go to redstone.finance, and thanks to REDSTONE for supporting us here at the Edge podcast and Edge newsletter. Banks use your money to line the pockets of shareholders. Meanwhile, Solstice uses the same yield strategies to line your pockets. Introducing Yield Vault, Solana's best yield. A live delta neutral strategy with positive returns month over month for 3 years. built for internet capital markets and powered by the stablecoin USX. To learn more, go to solstice.finance. NEUTRL is the next generation of crypto-native yield. Their synthetic dollar NUSD taps into OTC arbitrage, funding rate inefficiencies, and delta-neutral strategies to deliver premium, stable returns without taking market direction risk. NEUTRL is currently live in private beta and will be opening for public deposits soon. Learn more at neutral.fi. All right, let's introduce Ruca, Head of Growth at KPK, and Giel, Head of Risk Curation at KPK. Guys, welcome to the Edge Podcast. How are you doing?
Super excited to be here. Thanks for having us.
Yeah, same. Great to be here. Excited to talk about this.
Why don't we just get right into it? Let's talk about this historical context around KPK, and then I really want to, again, dig into your expertise around what is a curator supposed to do and what is a curator actually doing in today's DeFi markets?
Yeah, I can do that. So we've been around for roughly 5 years or so when we started out as Gnosis DAO's treasury manager. I actually sort of created this space back in the day. And the reason for that was that back in 2020, late 2020, Gnosis decided to move all of their governance structure towards the DAO one, and they moved all of their treasury towards a safe multi-sig that was governed by the DAO itself. So everything was in the open, very Ethereum aligned as everything that Gnosis has been putting out there. And they needed someone to take care of the treasury. And back in the day, it was something like $1 billion worth of assets, like hard assets, like ETH and stables. And Marcelo and Ale were co-founders. They were the ones really, overseeing the management of that treasury and started really deploying the treasury. This was DeFi server, by the way. So they started deploying in the treasury in DeFi protocols, doing a bunch of yield farming. And the purpose of that was to generate non-income cash flows that would be able to support the multitude of initiatives that the Gnosis DAO was undergoing back in the day. So I don't know if you guys are aware, but Gnosis has been behind the creation of a lot of Ethereum infrastructure, the Safe, it's Cow, and even DAO infrastructure with Gnosis Guild and the Zodiac standards. So they needed a way to have sort of this trustless way to manage their funds, and they just decided through a governance proposal to make Karpathy, back in the day, now KPK, the official treasury manager. For us to do that, we needed to do everything in the open, right? So remember that back in the day, the way DAOs governed themselves was through super ossified governance proposals around capital allocation. So for specific investments, for supporting proposals, fund management, accounting, whatever, everything was had to go through governance approval. And when it comes to DeFi, as you can imagine, and given the volatility of the markets, that would make it impossible for them to operate in a capital efficient way, right? And we really pioneered the non-custodial asset management on top of Safe and the Zodiac standard, meaning that we have built infrastructure to be able to remotely access a multi-sig that was controlled by the DAO so that we could execute pre-approved strategies and with that be responsive of any market opportunities. And that's how it came to be, essentially. Fast forward, we took over the DAO treasury management market. So, we onboarded companies like Cow, like Balancer, later Aave. We worked with companies like Uniswap, Arbitrum. So we did a lot of research on that end as well. And with that, we gathered a significant amount of subject matter expertise that we're now using to kickstart the curation.
Let's start with the state of curation then. I think what I want to hear from you guys first and foremost is what is the role of a curator in your minds? Like, what do you think your job is?
To me, like a curator is someone who sits on top of the code and acts like a portfolio manager by picking pre-approved strategies, setting allocation rules and adjusting various risk caps without touching user funds. That's like the ideal scenario. I know there's been a lot of discussion lately, like what is a curator, like what type of assets or strategies are considered under this umbrella. And I think it's important to realize that there's actually two main types of curation. So one is the classical lending markets risk management. So things like Aave, where the DAO manages the risk of the underlying lending market. So you will have the curator, in this case, the Aave DAO, which has to manage the risk parameters and protect depositors to make borrowing efficient and like enable borrowing for people that want to take on that role. And the main goal there is to make sure that the borrowers remain over-collateralized at all times, and they have an incentive to repay their loans. And that's something recently we've been seeing that has been that has been really tricky. So not always that incentive is there to repay loans, and then you can get into really tricky situations. So to me, like, curators play a role in this type of over-collateralized lending markets, but also under-collateralized, like more Pareto, which are focused on institutional credit, which is seeing more adoption nowadays. But the hot topic of the day is a second form of risk curation, which is the yield vault curation. So this typically involves tokenized vaults, often ERC 4264 or 7540 architecture, where people deposit a single asset and it's then deployed into various yield strategies. And there the curator is actively investing these deposited funds. So the role there is really focused on allocating and rebalancing these positions across predefined on-chain strategies. So the curator sets allocations, rebalances the positions into one or multiple protocols, and often takes a performance fee for doing that work. So most often this includes monitoring the liquidity real-time, managing the underlying assets and protocols. And essentially you can see it as a sort of programmable yield wrapper. So you can have multiple sources of yield in there. It could be coming from AMMs, like liquidity pools. It could be tokenized RWAs. It could be lending markets. It could also be like a leverage basis trade, for example. So they don't necessarily have to be built on lending markets like Morpho or Aave, although often they are. In the 2021 days, the most famous example is like Yearn, which is this type of auto-compounding vault, mainly focused on providing AMM liquidity, at least back in those days. So right now we see a lot of more these exotic products show up, where sometimes the curator does have access on these funds. And typically now we also see a lot more a role for curators to distribute these products. So you can think of Morpho Blue Vaults, which are also integrated into Coinbase, for example, for people to take on loans. So there you now also have this thing about distribution separate from infra. So you don't just need to have the code, you also need trusted actors, which are the curators who can like package these products, monitor them, and grow them through various verticals. And unfortunately, I believe the rise of permissionless lending markets has led to an explosion of the number of curators, and not all of them are as experienced, or they might have different motivations, might run a more loose risk ship than others. So that's where it can get tricky for the end user.
So this is an important point to make, the distinction between these permissionless lending markets like you find on Morpho, Euler, Silo, Gearbox falls into this now as well, versus a vault that is acting as like a hedge fund. Can you just talk more about the responsibility, the difference in responsibility? Like, a risk curator to me is the person who's working with those permissionless lending markets on Morpho. Someone who, says, hey, you can put up CVBTC and you can borrow USDC. And there's other parameters to that, but it's very narrow, the scope of like what can be done there, versus this other example, which is probably more like a Midas vault that you put money into and then it's basically run like a hedge fund. Can you just talk about more of like what goes into this? Like what does it take for someone to run something like a Midas vault versus being a risk curator for the simplest types of morpho lending markets?
Yeah, great question. And I believe they're also, you're right, like morpho is a quite simple system in a way. So the vaults on top, which are the one you can deposit into through the UI, they allocate funds to different isolated lending markets. So the role of the curator there is to first vet which markets they want to allocate to, and then execute on the allocations. So decide, I'm going to allocate 10% here, 20% there, 50% there, maybe keep 5% available for immediate withdrawal. So there really the role is to make sure that you're getting a good yield in a safe place, and there's also instant exit liquidity for the depositors. And you're limited to a single protocol, basically. I know with Morpho v2, there are going to be some changes there. You'll be able to do more advanced strategies. But right now, it's a quite simple system. And you do things like Midas, or you have all kinds of platforms, infrastructure. You have IPOR, you have other protocols built on top of Yearn, like Superform, etc., where you don't really have much limits on the strategies. You can do whatever you want, basically, but it means that you can also enter into very risky positions that might not be allowed on Morpho. So even though like Morpho is like a permissionless infrastructure, there are some safeguards in place in the UI. They won't be listing any market there. You need to pass through some checks to be whitelisted and viewable. So the problem with the really permissionless vaults that are sort of the Wild West is that the curator has all the control. And if you enter into too risky positions that are illiquid, or you end up taking a DPEG on a stablecoin, like funds can get lost, and in the end they will get lost, like if you engage in this risky type of behavior. So their risk management is even more important, and also liquidity management. So you want to be able to offer redemptions to users. You don't want to be stuck in, let's say, a Pendle PT position that expires in 6 months from now. Users will be depositing and withdrawing from the vault. You need to be able to accommodate that.
So there's a few things I want to point out with the Morpho market specifically, and then I do want to talk more about the shortcomings of these tokenized vaults, like something like Midas. With Morpho, and correct me if I'm misframing this, but with Morpho, there's limitations to what can go wrong. So one of those limitations I think about is liquidity to withdraw, which is what happened over the past week. There was a bunch of liquidity that withdrew. Certain Morpho markets that were lending to other Morpho markets withdrew that liquidity because it was needed elsewhere. Like, this is the problem with a few different curators working across lots of different markets. Suddenly they had this ability to like move liquidity around. And if you had lent, let's say, USDC to borrowers who were over collateralized with a Pendle PT token, then you might not have been able to withdraw that day. However, aside from liquidity not being able to withdraw that, there's also interest rate risk for borrowers. So we saw interest rates spike across lots of different pools because when the lending liquidity got withdrawn, we then had interest rates go up, which then incentivized a lot of the loopers to unwind their positions. And they can unwind those positions really without having to worry about the liquidity because they're the ones that are depositing their collateral, basically slowly, manually unwinding that position. Okay, then there's also default, which if a borrower just straight up doesn't maintain a healthy loan, their collateral can be liquidated. But then that leads to, I think, the final sort of negative end result that you could see, which is if someone defaults on their loan and their collateral is bad, well, now you have bad debt. And that's essentially what's happened with xUSD and the Elixir, whatever you want to call that thing. It's not a stable coin, but something like a stable coin. It's like a yield product. Am I covering all of the bases there? I mean, these are the different ways that I've thought of things going wrong in Morpho. The worst of those being if collateral that is being used to borrow against suddenly is not worth its value, well, then that's where you actually accrue bad debt. But these other things they're forcing mechanisms. If there's no liquidity to withdraw, then interest rates spike, and folks should be very incentivized to pay back their loans. And that's kind of what we've seen. All this unwinding has been happening the last few days, and that is not hurting anyone. I think that is isolated from the collateral and the bad debt. This is something that is a positive to the way the system works.
I know. I just want to say that I read a lot of criticism on some sort of the morpho mechanics and what, the lack of liquidity on different vaults that had no exposure whatsoever to xUSD and other distressed assets. But at the end of the day, the system behaved exactly the way it was designed for, right? You have, it's supposed to, the lack of liquidity is supposed to create a spike on the interest rates, which is supposed to incentivize the repayment of the borrowed funds, and there you go, right? And the proof of that is that 2 days in, and then the liquidity got restored to most of the vaults that had no exposure, and it is what it is, right? I also like to point out that we're talking about, as Giel pointed out, this is a fairly simple protocol, right? And I would say that the degrees of freedom are very limited, and the more degrees of freedom, the more the risk vectors that you can add into the system, right? So if you have one of those yield generating vaults that can deploy pretty much whatever, then you start to add duration risk, for instance, which is, it's something that you generally don't see on Morpho, because what happens when someone goes on a Morpho vault and tries to withdraw is that, liquidity gets automatically and atomically withdrawn from whatever possible in whichever markets are deployed into. And that's just not true in the case of a typical yield vault, right? Because, you might be deposited in a token that got locked, for instance, it could be SUSD, for instance, that has a 7-day withdrawal period, for instance, or otherwise, if you need to get liquidity, you have to go to the secondary and, get a haircut on the underlying. Like, there's a lot of, additional degrees of freedom that add risk to the investment, but it's just the nature of the game.
Yeah, I think just for example, on Morpho and all lending markets, or at least isolated lending markets, the main risk is if you're a lender in there and indeed the collateral goes below its fundamental value, as they say. So then you can get into a real... Okay, let me rephrase this. So I believe the main risk in Morpho and isolated markets in general is, as a lender, if you're deposited there, you're very dependent on what the collateral does in that isolated market. So if it starts depegging and liquidators don't show up on time because they're not incentivized to do so, or they're not able to withdraw or redeem the underlying asset, for example, there might be withdraw queue, there might not be sufficient AMM liquidity for it, that's when it gets risky. So this is something you see with more severe price ups. So if something drops more than 10%, for example, below what you would expect its fundamental value to be, then you get in a situation where the liquidation bonus for liquidators doesn't cut it. And you can be stuck in this position where somebody is max borrowing against a token that is overpriced. So pricing in these lending markets is crucial. And I believe that's a big or the biggest risk vector there. Of course, there's a lot of solutions for it, but it's something to be aware of. And curators should double check the Oracle configurations, etc. for those assets.
Before we go any further, we do need to talk a little bit about what happened with Stream. And could either of you just break down what happened, what's the blow up, what failed, and what was the contagion that followed with Elixir and some other protocols?
Yeah, I'll give a high-level overview. So Stream Finance was a vault that people could deposit into. In response, if you make a deposit, like a stablecoin deposit, you get a receipt token called xUSD. The idea is that xUSD would always be worth at least $1 and go up over time, if I'm not mistaken. The one thing they did, with the incoming funds, they did a lot of exotic leverage looping strategies. So they shared their wallets. You could track the positions they were doing initially. And then a few months in, some funds started moving to exchanges and like other ways where it's no longer possible to track all of this. So transparency was lost. Of course, if something doesn't happen fully on chain, it's very hard to keep track of it. You have to trust the team and their explanation. So what came to light earlier this week was that presumably on 10/10 or in the wake of it, one of their associates that they lent or gave money to has lost over 92 million of it. I'm not sure. We still don't know exactly what happened, whether it was a strategy that blew up because of market fluctuations, maybe auto-deleveraging, or maybe it was something else. We really don't have any clarity on it, but the fact is, like, a bunch of their underlying assets got lost, so they basically beat back overnight, but the vault itself kept running. So what they did was they had a lot of leverage looping on other platforms, so on Euler, for example, on Morpho as well, with various collateral. And how they did is they also had deals in place, so private deals, which led to the demise of other projects later on. So they would, for example, allow other projects to use their xUSD as collateral, loop it, and they would do the same with the other parties' stablecoin. So they would, for example, like take 90 million from Elixir and then also send them 90 million and try to like increase each other's TVL, which was a very risky situation. In the end, so we noticed there was a big impact. There are a lot of these loop positions that, for example, have xUSD as collateral and they are max borrowed against. So there's 100 million borrowed against the xUSD that is gone out of that market and that is never going to be repaid. Why? Because the xUSD dropped way below its fair value. And the problem with this lending market was it made use of a hard-coded oracle, so meaning that it assumed that the xUSD price was 1. Or maybe that's not entirely correct. Like how it works is a vault that was updated by the Stream Finance team, the oracle, so they never updated it to the real underlying value. So this is where you come into this trust issue. You have to trust the team to update the oracle when it's not fully based on on-chain data. It's different with other protocols which have a more trustless approach, like Lido, for example. You can like verify the reserves very easily. You can query like a Chainlink oracle to have a proof of reserves, etc. This was not the case here. So you kind of have to trust the team that everything is fine. And when things then go south, you come into a very tricky situation. So what happened in the wake of it is that, for instance, Elixir tried to withdraw their funds. They couldn't withdraw it. This led to a depegging of their DUSD stablecoin all the way to 3 cents. They eventually now shut down redemptions and mints, so the protocol is fully paused. The infrastructure has been shut off. And this will largely lead to a lot of big losses for people who weren't even directly using xUSD and Stream, but who were using Elixir. You have a lot of other protocols that also had contagion from it. So, for example, you had losses to Stable Labs' USDX stablecoin, which are also severely depegged because of a big Stream position. And same for Trevi, which had, like in their staked STUSD, had 92% exposure to Stream. So they're now in the process of litigation. I believe also Elixir is litigating against Stream Finance because they had a private deal with them to allow one-on-one redemptions. But it doesn't seem this will be the case, that this is going to be honored, and very much to be determined who's going to be left holding the bag, because essentially they're like a tokenized hedge fund. So under this framework, you have different repayment priorities. You have the secured creditors, which are like the xUSD loans directly made by Stream. We also have unsecured creditors, which are like service providers. The legal costs, they hired a very expensive law firm that will require compensation. And lastly, you have the equity holders, so the xUSD holders, which in my opinion, my basic interpretation of this is they will be last in line to receive any residual funds if there are any remaining. So this is a very bad situation, I say, which started by taking on very high risk and in a very opaque system. There's more explainers elsewhere on the internet about what exactly went down, but yeah, that's the gist of it. So they ran a very risky strategy. One of their strategies failed and they got hit, and a lot of lenders in lending markets that were relying on the value to never go below 1, they're now stuck in a position where they're not going to be able to see their money again.
So this all starts with xUSD losing 93 million, but do we have any estimate for the extent of all of this damage, all of this value destruction? Because I was looking at USDX. Hopefully I'm looking at the right one. Stable Labs USDX. So whatever the math is on that, I mean, that's like almost like $400-500 million it's already destroyed. And I mean, not to put a nail in the coffin on them, I don't understand like what happens next on something like this. Is there any like plan to bring something like that back to life? But this is due to the contagion of that. And then I'm leaving out Elixir. I have no idea how much value in total was destroyed there. So
yeah, I believe it's in the billions. So 1 to 2 billion. Of course, it's not entirely clear because there might be more people affected or more protocols affected. That's something that will surface over the next few days and weeks, I assume. But yeah, it's especially, it's like in crypto trading, you know, like if you use leverage and you do a 10x leverage, your losses are also going to be amplified by 10. So that's the tricky situation. It's not only limited to Stream's TVL, but also all the leverage built on top of it.
And opacity gives these guys more time to be able to, you know, move capital around to be able to disguise a lot of the shit that happened. So, you know, if as Giel pointed out, like this whole thing started in 1010, right? And we don't know what happened, but, you know, the rumor goes that somebody big blew up and, you know, there's after effects after that, right? And it because everything is interconnected, you know, we were talking about sort of a negative flywheel that creates out of it.
This episode is brought to you by MANTLE, pioneering a revolutionary new category called blockchain for banking by bridging TradFi and Web3 into one unified stack. With on-chain transactions, TradFi rail compatibility, and integrated DeFi features, MANTLE is reshaping how financial services work. Their flagship app UR lets users hold fiat and crypto all in one Swiss-backed account, making real-world finance usable on-chain. To learn more, go to ur.app and follow mantle_official on Twitter.
KATANA is an opinionated blockchain. Its opinion is that for DeFi adoption, there are two key things we need: deep liquidity and high yield.
To learn more, go to katana.network. As a DeFi investor, I turn to Maple for permissionless institutional quality yield in a single liquid asset, backed by over-collateralized loans. Maple's SYRUPUSDC and SYRUPUSDT are now supported as collateral for enhanced yields on major DeFi liquidity hubs such as Pendle, Fluid, Camino, Jupiter, Morpho, and soon Aave. To learn more about Maple, go to maple.finance. I think one of the criticisms this week has been that the incentives, the alignment of incentives doesn't make sense with risk curators. I'm not sure if I agree with that or not, but I think one of the ways you can begin to discern that question is who is paying curators? How do they make money? Talk to us about, like, how does the business model even work? Like, why are they running these vaults? And, you know, are they being paid to create vaults, or do they just create the vaults and live off performance fees? I've never fully understood it.
It's a good question. That's something we also had a look at before entering the curation business, of course. So The easiest situation is in the first form of curation I talked about, the permissionless lending markets, because there you typically, the curator would take a fee on the borrow interest that is being generated in these pools. So there it's a quite clear-cut thing. It's like how Aave makes its money. It's like taking a spread between the lenders and the borrowers. On Morpho, for example, it's different because Morpho doesn't charge this type of fee to the DAO, for example. In Morpho, you do have the ability as a curator, if you build a vault on top of the isolated markets, to charge a performance fee. Not all of the curators do it, like the biggest vault doesn't have any performance fee. There are some other compensation mechanisms possible, so either is through direct deals with the asset issuer. Something we noticed, especially true for like the smaller, newly launched yield-bearing stablecoins or LSTs or LRTs, where they will hire a curator to set up a lending market to facilitate growth. That doesn't have to be a problem as long as like those curators like still stick to their proper due diligence. Another way to make money is just grow TVL and grab as much market share as possible. And then you have the protocols themselves that often has a type of reward program. Like with Morpho, it's called the Morpho Olympics. Once you cross, I believe the threshold is about $65 million worth of TVL on mainnet, you get a kickback in Morpho tokens, which are locked for 1 year, but still like it's a pretty nice compensation for the top curators. So they will earn millions doing this, for example, and maybe it's also worth it. Like they're in the business of growing the TVL of the protocol and having sustainable yield sources. So I don't condone this, but like that's typically how this would take place. And performance fee is like a double-edged sword because you don't want to set it too high and scare away users or eat into their yields, because then they might as well just do it themselves. You know, you're not going to pay someone to do a relatively basic job in Morpho. If you want, you can do this yourself. You won't have the automation, you will underperform, but if somebody is charging a 20% performance fee, you might get really close to it. So in our opinion, it doesn't make much sense to charge big performance fees, for example. Like we're going to go with zero performance fees on our vaults for at least the first few months and then reevaluate. But there's all kinds of, I'd say like income sources. And then you have some private deals that might be, I don't know, because we're not in these type of conversations, but you never know what goes on behind closed doors. I heard rumors about, especially then with Stream and some more of these other yield-bearing stablecoins where you have agreements between different protocols to deposit in each other's vault and grow TVL that way. I'm not sure what the compensation, if there is any, looks like, but I can like speculate there might be some revenue generated that way as well.
I write this column, Yields of the Week, and I even find myself, struggling to try to find the best yields. But what are the best yields? There's a lot that goes into that. And I think DeFi is sort of a meritocracy, right? So, protocols that have the best yields sort of rise to the top and get the most TVL. But I think we all started looking at one metric, which was yield, and not looking at the hidden metric of risk. And I want you guys to kind of speak to this as well. So actually something else I saw just this week, actually just days after all this blew up, was REDSTONE bought Curators a while back, and Curators has come out with, they're going to be doing risk ratings for all of these vaults, which I love to see that, like a forcing function for everybody to bring it up to snuff essentially. But curious kind of what you think of this holistic situation. Wondering what you saw. Like I know what I was seeing. I was seeing basically a yield frenzy happening, and kind of where you think we go with this new risk rating system. I don't know if you've had time to dig into this Curators stuff, but kind of want to get your take on how this could protect users essentially.
Yeah, I'm not sure if Ruca wants to go first because we do have a long history with Curators. If not, I'll take it.
No, it's okay. I can do, but it's going to be an obvious question, right? The more due diligence you offer by accredited third parties, like the best, right? For me, it's like and we saw this coming for a couple of months now. You don't see, whenever you show up on a nerd page on any of these curation platforms, you don't see the vaults organized by risk, right? You see the vaults organized by TVL and by yield, right? They let you pick either of those, right? And people, I don't think they generally understand that yield is a proxy for risk, right? It's like it is what it is, right? And it creates like a perverse feedback loop where we end up with curators fighting for attention, and the way they do that is, they want to go down the risk curve and offer the best deals because they know for a fact that that's the best way to increase their TVL, right? So there's essentially two ways that the typical retail person uses to understand where to deposit, which is TVL, which is is connected with the Lindy effect, like how many people trust this vault. Like it has nothing. There's nothing connected with the underlying risk of the vault, and there's the API, right? Then the API is like, okay, let me find the best way to generate the short-term return on my capital, and that's just the way it goes. For me, this creates these boom and bust cycles that just make that curators have to perform riskier allocations, and that it's just a matter of time until some of them blows up.
I have hypothesized for the longest time that many of the risk curators are just they're running their own liquid strategies, so they're setting up these markets. And even though there's clearly a model there's an incentive to set them up. I've looked at the interest rates and thought, like, why am I able to borrow at, let's say, 6 to 7 to 8% against exotic collateral, but let's say borrow USDC against a Pendle PT, even though I view a lot of the Pendle PTs, depending on the underlying asset, as being extremely reliable. So I've been borrowing and then looping that up, and I feel like I'm in the driver's seat as a borrower. I put up my PTs, I borrow USDC, swap it for more PT. So I've like manually created a 5 to, let's say, 6x looped position. And the end result is, because of the super low interest rate, I've been able to achieve a net APY of, let's say, 30 to 50, sometimes even like 100%, depending on the platform. And then I've thought, why are these folks lending to us at 6, 7, 8%? Like, it just doesn't make any sense to me. Not that they're going to run the exact same strategy as me, but it just felt like a total mispricing of the assets that they're lending. And so my conclusion has been, they must be running these strategies as well. They must be lending and then looping that up as well, because otherwise, again, why would you lend knowing that there could be a liquidity crunch? You won't even be able to withdraw, and then you have to essentially depend on the interest rate spiking. What are your thoughts there? Like, am I mischaracterizing what's going on in this space? Like, I feel like a lot of these risk curators they are not just risk curators, they are running liquid strategies, and like, that's the real business. And again, they're benefiting from the way they set these markets up.
Yeah, there's a lot to unpack in your words, but I would say that first point is, there's a lot of idle capital sitting around, and especially now that we open up the floodgates of retail applications with this, integrations with sexes and whatnot, there's a lot of capital that is idle sitting there, and their owners are not able to put it to work the same way you would, right? So that's the first observation. And as for the second one, I would see it as a bit far-fetched. I don't know. Maybe I'm a bit naive. But again, like, it seems again, to my previous point, that people are playing super complex games and without the proper infrastructure. to be able to unwind those positions. Somebody will get burned for sure. But I would say that, there's a lot of capital, and we talk for ourselves, right? The deployments that we do on behalf of the DAOs, DAOs are like endowments, right? It's the most boring portfolio allocation you'd ever see, right? It's essentially, deploying stables on lending protocols, and that's mostly it, right? So that's where, you see borrow rates going down, right? Because it's just, there's a lot of demand, there's a lot of supply side, right? That's just, just wants to make a buck on their USDC balance. But I would say that would be my best guess.
It depends on the type of curator. So sometimes you see, for instance, like even liquid funds who are curating on some of the more exotic lending markets. So for example, it's typically on the more newer chains as well, things like Plasma, etc. You have a lot of these more niche or smaller liquid funds. They are curating a market, and for sure they're also deploying funds there. But you also have more, let's say, I don't think the gauntlets or like the bigger fish in the pond are doing this type of behavior. It's more like these niche boutique shops that just have set up shop, and they're using the curation business as an extra arm of their liquid fund. So I think there's a big distinction to make there.
River is building a chain abstraction stablecoin system that connects assets, liquidity, and yield across multiple chains. Season 3 is live. Earn River points by using xUSD in DeFi such as Pendle, PancakeSwap, and Uniswap. Stake River points to accumulate more or convert points to River tokens whenever you like. To learn more, go to river.inc. Hey folks, I want to tell you about our sponsor Gearbox, the protocol that reimagines on-chain lending. With Gearbox, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about Gearbox, go to gearbox.fi. Puffer Institutional delivers secure, high-yield Ethereum staking built for institutions. With battle-tested security, granular access controls, and the ability to boost APY by securing multiple AVSs, Puffer gives institutions full control and optimized returns. Puffer is also behind the Unify-based rollup, aiming to transform Ethereum's future in a world where all L2s are working together. To learn more, go to institutional.puffer.fi.
But something that you mentioned in there, Giel, that I want to get into just a little bit more is this idea of oracles and to peg or not to peg. Can you sort of break that down a bit? I just throwing out that there's another massive protocol out there, Athena, that has, I believe, pegged oracles in Aave. But yeah, maybe break down what this means and this choice.
Indeed. So yeah, you have two types of oracles that are being used in lending protocols broadly. So one is the hard-coded oracle, also called fundamental or backing value or exchange rate oracle. So the basic idea is that you price a token based on the reserves that back it. So for Athena, that would be, for example, like USDT and the strategies that you do with that USDT. With Lido, it's, for example, the underlying ETH that's being used to validate the network, the Ethereum network. And you have a second type of oracle, which is the market price. So this is a price by which a token is bought and sold on DEXs, SEXs, or any other liquid market. That's the most famous example is like Chainlink. Most of their price feeds are of this type. Not all, but most of them. The choice between like hard coding or packing your oracle or not really depends on the type of asset and the type of market. Maybe just to give you a difference through different scenarios, what would happen if you have a big market crash, for example, and you have either of those oracles. So with a hard-coded oracle, you don't have any liquidations in case the market rate drops for the asset, which is very good for borrowers, especially for illiquid tokens that are prone to market manipulation. But it can be very risky for the lenders that are in that lending pool, especially with severe price drops when you go below 10% of what would be like the fundamental exchange rate. You open up this attack vector, where somebody can buy the token on the open market, then go into the lending market and max borrow against it, and then use that lend TVL to exit the market and use it as exit liquidity, basically. So for lenders, this means their funds can be stuck or illiquid in the pool due to lack of incentives for the borrowers to repay because they essentially made a profit doing this. This can be a temporary situation, but it can also be permanent with a heavy DPEG, as we see now for xUSD and the market on Euler for it. So in my opinion, it's the role of the curator to avoid such a situation, either by selecting a more robust oracle or by pausing borrowing in this type of situation. So that being said, it's not always bad having a hard-coded oracle. It can be very important for illiquid tokens, like niche LSTs and LRTs or yield-bearing stablecoins. And there isn't any problem of using this type of oracle as long as you have redemptions that can take place smoothly. So if you can withdraw the funds again, even if it's with a delayed withdrawal, like a 7-day queue, etc., you can be fairly safe to use this type of oracle. So with Athena, for example, that's the case. You can, if you're a TOROS participant, you can have a one-of-one redemption of USDE for USDT. So in that sense, it's okay to use this as long as these redemptions keep taking place as expected. With the market rate oracle situation is very different. So there is a much faster reaction to market drops, which means lenders are more protected, but borrowers are at risk. So even small price drops will lead to liquidations there on the more risky positions, those that are highly leveraged. And this is way less attractive for borrowers as they must maintain higher health factors. So it's less capital efficient and also more risky for them. There's all kinds of edge cases as well. So market oracles can lead to liquidation cascades if the asset's pricing drops even faster than liquidators can step in. And that leads to bad debt and insolvency in this market. So yeah, that's the main difference. It's the relationship between lenders and borrowers with these two type of oracles. You have some protocols that try to solve this by having a dual oracle system, for example, so you can have the best of both worlds. I think Gearbox is a great example of that. They always use 2 feeds for each asset, so you have a main oracle feed and a reserve one. One is typically a market rate feed, the other the underlying. And the way they do their system, I won't go into too much detail, but it's a way to avoid excessive liquidations on the borrowing side and protect lenders on their lending side, so they don't get drained if there's inflated valuations. So in my opinion, it's a very interesting and underrated system. And there's more things you can do to make lending safer in lending markets, like having native withdrawal of illiquid assets. That would be very interesting, for example, to see in Aave as well. With Aave v4, this might be possible to have native redemptions within Aave of USDE to USDT. It's already possible in other markets like Gearbox, for example. So it takes away a lot of the tail risk there. And there's also a third type of oracle, which doesn't rely on the, let's say, underlying exchange rate, but it's really hard coding it to $1, for example, for a stable coin. So this is something that we've seen as well. It's not based on reserves. It's not based on an on-chain query on what the fundamental value is, but it's just literally saying, oh yeah, here's my word. It's always going to be $1 or more. We've seen this even yesterday, even a pre-deposit vault, putting the oracle at $1, getting max borrowed against those lenders are stuck in there now. It's something I would not recommend of doing. And it's very difficult for users to know what type of oracles are used. So yeah, it's a tough situation.
I think because of the events that happened this week, all of the critics come out of the woodwork. Everyone that wasn't sharing their critique suddenly gets very critical and very vocal about that. And I, for one, can attest that I think that these fundamental oracles that are there for specifically for ETH LSTs and LRTs, and then I guess it's happening for a very narrow set of stable coins. they are important because borrowers will be liquidated on these like Oracle manipulations, these like goofy instances in the market when there's not as much liquidity and some whale is able to push the price down of something like an ETH LST and then force liquidations to happen because there's lots of looping that happens there. These fundamental oracles, these setups to peg to a certain price or to the underlying, in this case with like an ETH LST, ETH LRT, and in some cases stable coins, there's like really sound reasoning there.
It reminds me about what you said before about Credora, which are now moving back into the risk assessment or like risk scoring for morphovaults. Like one of the criteria they use, and we also use it in our own like APK internal risk management, is called a probability of default. And that means how likely a certain asset is to experience like a significant loss of funds within a 1 year period. And you're right, like you would be surprised how high this chance of default is with some of the bigger names in the space. So Credora, for example, they rated USDE as having more than 1.5% chance of a significant loss every year. And this could really be catastrophic given like the amount of leverage that is built up on it, for example. So for us, we don't touch any assets that have a higher probability of default than 0.5%. And the Credora framework is great to like assess this. So because that's the one thing to keep in mind with all the yield farming DeFi, like you can ask yourself, like, is this even worth it? And I think with proper risk management, yes, it is. Because people do underestimate the power of compounding interest over time. If you, for instance, earn 8% annual yield over 5 years, you will have almost 50% more of your initial balance. So the trick here is minimizing the chances that you lose some of it. So you want to avoid default at all cost, in my opinion, and proper risk management and assessment is crucial for that.
Okay, so something Giel was saying has been on my mind a lot this week, and I haven't really thought too much about this since I can't remember when the curve hack happened or exploit in the code a while back, but that really shook me. And then the balancer, exploit also shook me recently because this is old code that we think is safe that maybe isn't safe. So I'm not talking about the stream finance stuff or the Elixir stuff. Personally, I was never touching that with a 10-foot pole anyway. It sucks if you got wrapped up in that, but they had no docs page. They had no transparency dashboard. You really had no idea what was happening with a lot of the funds. It was a poor gamble in my opinion, but there's other gambles out there that aren't just the strategies, it's the smart contracts. And I still worry about this. And there's this image I tweeted out that, has gone around DeFi, throughout history. It's this Nassim Taleb image of 1,000 days in the life of a turkey before Thanksgiving. And, for 1,000 days, the turkey's well-being is getting better and better. And it's like, hey, I like this. I get fed every day. And then on day 1,001, the farmer, instead of coming out with food, comes out with an axe and kills the turkey for Thanksgiving. I sometimes find DeFi like this, and it begs the question, is putting a lot of your funds into a vault for 7 to 8% yield even worth it? I hope it is, because this is, the industry I'm in, but really, really curious. I don't even know how you quantify that risk, and just curious what you guys think of this, or how you even, carve out that risk that's just inherent in everything that we're doing.
Yeah, I can go first on this one. I mean, anything that comes from my mouth would totally be biased, right? Because I'm a firm believer in DeFi, and that has the potential to dramatically improve traditional finance. But yeah, the risks are there, and so are they on traditional finance, right? It's just that they come in different flavors. At least here, I like to believe that by exposing the code, you have bigger chances of finding the angles. And what data shows is that the number of hacks has been dramatically decreasing since the beginning of DeFi, and that's just the nature of it. So much so if you compare the amounts lost against the total TVL in DeFi. And I actually heard someone, I think it was on an event, coming out with this study around comparing the losses with TradFi products, private credit and whatnot that would rate it with, triple Bs or double A's or whatever, and comparing that with the losses of DeFi, and you actually be surprised of how high DeFi is ranked on those types of financial products. So I do think that the research is still there, but it's definitely going on the right direction. It's just the nature of it.
Also, on that, it is quite spooky to see an older protocol like Balancer V2 in this case. It's not a V3, but a V2 who's been around since, I believe, 2021 to get hacked in this way, which has not been caught in any audits or other events before. So yeah, I do see it shaking up long-term confidence potentially in DeFi. But yeah, the risk has always been there, and it will never be completely eliminated. You can only try your best to minimize it as much as possible if you're building this type of infrastructure, or if you're using it as well to be well informed or let other people do the due diligence for you.
So I feel like we've waited way too long for this, but I'm curious, with all we've talked about, what are some of the things, I guess, strategies that you're working on at KPK to make these systems better for users?
There's multiple angles here. So we're working on different fronts. So the first one is risk curation, where we will be offering different type of curated products curated by KPK, typical simple deposit vaults where people can deposit their USDC, ETH, or other stablecoins in. And our differentiator would be, I'd say, the conservative strategy design. So really targeting sustainable yield from reputable sources, not going into these edge cases that might have nice short-term yield but are not going to be around there in a few years' time. And we do differentiate ourselves with a thorough due diligence. So for every integrated asset and protocol, we go through a list of more than 65 data points, both in internal due diligence and external risk scoring, including Credora, as well as others. And the main thing with us is we have a very strong technical background in building automations for DeFi actions in a safe way. So we can do non-custodial automations in a very advanced way, which we call the automation layer. This, in the curation field, we apply to do automatic protective actions in response to risk alerts. So for instance, we would have a hyper-native alert go off, and an allocation agent will automatically pull funds back to safety in a matter of seconds, in the next block. So we do have a lot of automation going behind the scenes. We will providing more info on how exactly that works as well. But we really focus a lot on minimizing any potential loss of funds, as well as using automations to also improve on the performance. So on the yield side, we do a lot of automation, for instance, in Morpho to allocate funds within seconds after a deposit comes in, or within seconds after utilization rates change on one of the underlying markets. So it's not just running a script every minute or every hour or every day. It's really continuous monitoring of each action that goes into these markets and the underlying protocols. So the continuous monitoring and clear response as a result of it is where I believe on the risk curation side, we can add a lot of value for the end user and a lot of peace of mind as well. But that's just an initial step to, where we want to go to. Yeah, go ahead, Ruca.
Yeah, also, definitely on the automation, but also on the execution ops, right? Because that's where, we came to be, right? Managing 2.5 billion plus worth of funds on behalf of the biggest DeFi DAOs out there. Really means that, we built throughout the years the risk management and execution infrastructure that would allow us, for instance, to execute remotely under very strict pre-approved set of policies. And those same policies are the ones that we're using, for instance, on the curation side, to be able to allocate specific execution patterns to the agents, allowing them to push call data that wouldn't otherwise be approved if gone through if it wasn't pre-approved. So that's just one of the examples. The other ones on the on-chain investment vehicles has to do with the automatic redemption and subscription of the funds themselves. So we put a lot of emphasis on internal OPSEC to make sure that we don't expose ourselves, even from within, to any kinds of risks.
So I understand the work you guys have done with major DAOs like Gnosis, but do you provide any sort of retail-facing product, or what can you tell us about that?
Yeah, I mean, we're actually using 5 years plus of experience managing funds for the biggest DeFi DAOs out there to be able to offer the exact same risk management and execution infrastructure to anyone out there. And what this means is that we're opening up our curation operations, and we started up with Gearbox, and we soon going to be opening it up with Morpho. And this is going to be the first time that any person out there can get access to institutional grade asset management services. So that's one angle. And then the other one, and which actually connects with what we've been talking about around transparency on price oracles and the underlying NAV calculation and whatnot, we're working on putting out there our on-chain investment vehicles, which are similar to any yield tokenized vault, but with the flavor, meaning that we're going to expose the NAV calculation and making it atomic so everybody can verify that the accounting is done correctly. And we're super excited. It's something that we've been working on for the last year or so. We've been testing it out internally. Actually, the first fund is out and it's been around for 3 months or so. We've seeded the fund from our own treasury. But yeah, you're going to be hearing more of that in the coming months.
Guys, I think this is a great place for us to start to wrap up. So first, I want to remind our listeners that they can learn more about KPK by going to kpk.io. They should follow KPK_IO on X. Also follow deepcryptodive. That is Giel's personal handle. And then otherwise, guys, thank you so much for coming on. Appreciate having a conversation about these very recent events. I think for me, it's all about doing more research to understand what is going on when you deposit your money. If you have no idea what folks are doing with those deposited stable coins or funds, that's not a great place to be in. So anyways, any final word for us before we go?
No, it was great being here on the podcast talking about some of the upcoming products we're going to be launching. So yeah, definitely keep an eye on our Twitter and just the major front ends of lending markets, etc., where we'll be active. So you can expect to hear more about us.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.